And it's the 25th of January, and really welcome to 2017, to be honest, because finally we got a bit of action here on the equity side. I'm just going to bring up and increase the size of the DAX chart, which has just rifled to new highs for the year this morning. You can see this big breakout to the upside. We've taken out the kind of high point that we had back end of last week, just shy of 11,650, and that's gone and up through 11,700 and propelling higher. You can see on my S&P chart just to the right of that, if I make that a little bit bigger, that's just broken yesterday's high, and therefore if I go to a daily chart, yesterday's high just about, well, really was flirting with this top we had mid-December, but you would say now, well, officially the S&P is trading at levels never seen before in history, so new all-time highs for the S&P. Not so for the DAX. It's got a weekly chart for the DAX, because you've got to bear in mind, we can't even see it there. Yeah, hang on, let me get this into picture. Let me go, I'm going to go to a quarterly chart. Let's see, here we go. So the top all-time ever high for the DAX was set back in the immediate aftermath of the ECB beginning their QE program. You can see the big explosive move to the upside that we had in Q1 of 2015, which was all about ECB quantitative easing. That got us up to almost 12,500. So whilst the DAX is powering on here, new highs for 2017, and indeed higher, we did not trade this high for the whole of 2016. So actually you're looking at, I mean, it's not far off 2-year highs here for the DAX, but still not an all-time high like we're seeing in the S&P. An index that does need to be mentioned is the Dow Jones. Again, just from a price point of view, obviously the Dow's following all the others here on the upside. So we're just testing 9,900, new all-time highs. And of course, people have been talking about Dow 20,000 for quite some time. And if I go to a weekly chart, you can see that actually the Dow is not on an all-time high yet, is it? Sorry, we were higher than that back mid-December, so the Dow has not been able to break its December top yet, but that high was at 9,968, just 32 points short of the 20,000 barrier. And as we approached that into the end of 2016, it really just killed momentum, and we've been flat ever since. But definitely some appetite here. Finally, 2016, and you can see perhaps best on this S&P chart on the right, we've been flat for 5-6 weeks. Now we're just sneaking up through the tops, and a little bit of positivity with regards to sentiment. I'll talk about bonds in a minute, but bonds certainly on the way down. And what's I guess the appetite on the upside here for risk assets, perhaps coming from a few different factors kind of all rolled up. Firstly, if we just checked out some of the data that we got from yesterday out of Europe, I'm just going to switch my screenshot and just show you the manufacturing PMI numbers that we got yesterday morning. This is for preliminary data for January, so it's really the first look at economic activity in 2017. This is the most up-to-date, almost lead indicator data that we get, tier 1, and this is the German number that printed better than expected, and indeed matching this level we had at the start of 2014. And if I go to a 10-year view, you can see that level start of 2014, which is now we've climbed back to. We're really pretty much looking at the best levels we've seen since 2011, basically. And this 2011, these readings above 55 don't happen very often. This 2011 period where we spent more than 12 months above 55 was mainly about Germany benefiting from a monster stimulus package delivered in China. Germany's the most exposed European economy to China in terms of exports. If we go to max here, I can't go back any further than that. Anyway, the point is that this German manufacturing number is nice and strong. The French number matching the December reading, and if you go to 10-year print, you can see this is the best readings we've seen since 2011 for France. So these are the Eurozone's two biggest economies. France has been a bit of a laggard on the PMIs since 2011. Rarely have we been above 50. And, now this is quite bullish with regards to Eurozone economic activities we hit the start of 2017. So this has helped with sentiment. We've had, a bit of US earnings coming in and, also assisting with that. The likes of Alibaba, revenues up 54% in what's being described as a blowout quarter. Very strong numbers from Alibaba, not only beating expectations, raising guidance, raising their own forecasts. We had a big report out of SAP yesterday, also really strong numbers, and they've predicted strong momentum in cloud services, and this is going to pave the way for more predictable and higher revenue streams. So these are two big hitters, and both really solid, very strong earnings reports. This has fed into the sentiment as well. And then I would say if we just go back to the S&P chart and just zoom in a little bit, I'm going to go to let's have a look at yesterday's session, because where the move came was actually after the European close. We managed to get up to the high point we'd had from last week, and then we broke up through that. Now the timing of this move, which has really kind of fed into a good Asian session and now a continuation of the positivity this morning, the timing was off the back of a Trump announcement. So obviously Trump's in office, and so what he did yesterday that seems to have just built a bit of risk appetite is this decision he's made on the Keystone XL oil pipeline. So this is something that Obama vetoed. Let me just show you a map here so you can get an understanding of this. 1 second. So hang on, I'm going to change my screenshot. So this is what Obama did yesterday. Not Obama. This is what Trump did yesterday. I think this is thinking about a few different angles, right? Firstly, it's the supply of crude oil. So these are big oil pipelines. Up here at the top is Canada, of course, and you've got a big pipeline that comes down across the Canadian border, enters the US here in North Dakota, and then just goes due south straight the way down to Cushing, which is the biggest, the US's biggest oil storage facility, and then there's an extension down to the Gulf Coast. Okay, this is Keystone Pipeline. Now this blue dashed line here is the proposed Keystone XL pipeline. This is a proposed extension which will take a pipeline through Baker, which is another big storage facility which is in Montana, and then cutting down straight through South Dakota, and then picking up where the current Keystone pipeline is at Steel City. Now, Obama rejected this on the grounds of environmental issues, and plus some of this proposed route is taking it through Native American country where there's some controversy over, essentially kicking these guys out in order to build a pipeline. So Obama rejected it. Now, day 2 in office, Trump has signed this off and it's going ahead. Now, this has led to a bit of a boost on, let's say, the S&P side, and just adding to the sentiment. And it's the case that Trump's here, he's in office, and he is setting about policy as aggressively as he promised so far. Okay, the thing about this is, in the short term, it'll create a lot of jobs. Most of this pipeline extension is inside the US. Obviously, part of it is in Canada as well. But it's going to create a huge number of jobs to build this. Apparently, just the construction of it alone would add $3 billion to US GDP. That's just the construction process. Then what do you get after it's finished? Well, you get more oil capacity from Canada, which is big time part of Trump's plan, which is to become more self-sufficient. When he says self-sufficient, he means kind of North American sufficient. So that's getting oil from their own shale producers, of course, but then Canada and Mexico on either end. So he wants to become less dependent on Middle Eastern oil, and of course this plays into that. This would be great news for Canada, This would be incredibly positive for Canadian GDP in terms of oil exporting. Check out how this impacted the Canadian dollar yesterday. Let me just bring a quick chart of the Canadian dollar. Canadian dollar rallying strongly. We did a big break. This is when this kind of news was in the offing, and then it got announced and confirmed with a big move. Canadian dollar strength here off the back of this decision by Trump. So this is kind of the three factors, I would say, that are leading to what seems to be some pretty powerful risk appetite here today and the back end of yesterday's session. It's good earnings, it's really strong PMI data from Europe, and it's Trump delivering what will be at the very least short-term positives for the US economy. With the Trump thing, I don't know, markets are seemingly still in the mood of reacting to anything that's positive in terms of Trump actions, but seemingly ignoring any kind of negative risks, because yes, Trump has signed off on this Keystone XL pipeline, but then of course he's threatening to build his wall. He's already ripped up the Pacific trade agreement. He's going to be renegotiating the North American trade agreement between Canada and Mexico. He's still his rhetoric towards China is still pretty aggressive, and so there's definitely risks ahead with Trump. But at the moment, it seems like markets don't really care, and they think that in the short term, Trump's business-like manner, his proactive, let's just get on with it attitude, sod the environmental consequences of building a pipeline, let's just do it. That seemingly is feeding through to initially what's a positive sentiment. So that's what's kind of creating the mood and the vibe in markets this morning. Another thing to talk about from yesterday, not in the end that it really kind of panned out any different to what we expected, but this was back on the Brexit topic, where we had the Supreme Court really pretty much deliver exactly the announcements that we were expecting. And that's probably why cable in the end, after some volatility for sure in both directions, we're trading where we were before the announcement, and that's just shy of that top that we had end of last week, start of this week, as we made it up through the 125 handle. A few things on this then. So the Supreme Court said that Theresa May does need a parliamentary vote in order to trigger Article 50. So we've got a graphic on this. Ant sent out something this morning. Let me just get this graphic into place, and I'll bring up on the screenshot. There's various different scenarios now. So let's just have a very quick look into what these scenarios are. So this is a diagram of how things might go from here. You can see at the bottom of this diagram, Supreme Court decision about parliamentary approval. So the Supreme Court upheld the High Court's ruling from last year. The government need a parliamentary vote to trigger Article 50. That means that they need sign-off from the Houses of Commons and the Houses of Lords before Theresa May can trigger Article 50 and get on with the negotiations. Fortunately for Theresa May, the Supreme Court didn't go further than that and go to the devolved parliaments of Wales, Scotland and Northern Ireland and say that actually they get a vote as well. That would have been a disaster for Theresa May's Brexit plans. That didn't happen. So what's going to happen now is Theresa May and her government need to put forward a bill for the Houses of Parliament to vote on. Now, there's three different options here with this bill. Normally, bills, this is proposed legislation, are pretty lengthy and can take quite a bit of time to firstly produce. Never mind then the Houses of Parliament and all the members of Parliament actually sifting through it, debating on it before then they vote on it. This stuff can take months. What looks to be happening is Theresa May is going to perhaps produce a short bill. So this is the left-hand side of this diagram. This is one scenario that might play out. A short bill is produced, let's say, in the next couple of weeks. And then this is handed to Parliament, and the HC is Houses of Commons, HL Houses of Lords, both vote on it, and let's say both sign it off by the end of March, therefore enabling Theresa May to trigger Article 50 in the first half of 2019. Remember, her timetable is she wants to trigger Article 50 and start negotiations by the end of March. The only way that's going to happen is if she produces a short bill and it immediately gets signed off by both houses. Okay, fine, that could happen. Another one might be a more normal bill in terms of its length, which will take longer to produce and it will take longer to get through Parliament. If that does happen, so look, Houses of Commons vote for the bill with discussions and eventually amendments, and then the Houses of Lords vote for the bill with discussions and eventually amendments, and then finally they sign it off, enabling Theresa May to trigger Brexit, trigger Article 50, but trigger it later than what she currently wants. So there's a chance that we might get a delay and that Theresa doesn't get her wish of triggering Article 50 by the end of March, and it might be sometime more like second half of next year. Now, with that scenario, there's actually one positive thing, I think. Well, carries risks, but there could be a positive thing, and that is thinking about European elections. The two biggest players in this negotiation are going to be Germany and France. They're the two biggest economies in the EU, and both have elections. Let's say we trigger Article 50 end of March. France are going to be embroiled in presidential elections in April and May. And then Germany have an election, a general election, which will either be in September or October. I mean, these guys are going to be completely... September 24th, is that the German... Sorry, we do have a date for the German election now. Sorry, I didn't realise that had been decided. September 24th is the German election. These countries are going to be entirely... preoccupied with their own internal politics, never mind thinking about anything external like Brexit. So if Theresa triggers Article 50 end of March, basically negotiations can't really start in earnest, I don't think, until we've got these elections out of the way. So really the first 6 months are a complete write-off. So it may be that triggering Article 50 in the second half of this year would make the 2-year period more productive, because we'll be on the other side of French and German elections. And imagine if Merkel loses. I mean, what then? Imagine if Le Pen wins in France. I mean, that would be any negotiations up to, let's say, the German election and then Merkel loses will be a complete write-off. They'll have to basically just start again. So there is an argument to say delaying it is actually not a bad thing. So we shall see how this pans out. Really, in the next couple of weeks, is it going to be a short bill? And are they going to vote it through? The thing is, Theresa May does have leverage over both houses. Houses of Commons. Well, here, ultimately, if the bill doesn't get voted through, there is a chance that's like a vote of no confidence in the government and triggers a general election. But Labour do not want a general election now. They are in disarray. They'd get annihilated in a general election. They're most likely going to vote this through just to avoid a general election, never mind whether they actually agree with it or not. Also with the Houses of Lords, you might remember from last year, there's a motion to reduce their power when it comes to voting on legislation, and any incidents whereby the Houses of Lords stick their oar in and delay legislative policy is only going to fast track, I would say, the movement towards the Houses of Lords getting their power clipped, and they don't want that, and so perhaps I would say they're likely to vote it through as well. So I actually think Theresa May's got a pretty powerful hand here in getting a bill voted through fairly quickly, so we'll see. Anyway, this is the timeline. It's really about now, what's the bill going to be, short or long, and then how long might it take to get through the Parliament. If we go back to the charts, with regards to cable, I think the most important thing was last week's speech, I think, where Theresa May ultimately said that both Houses of Commons and Houses of Lords will get a vote, not on triggering Article 50, they'll get a vote on actually the exit deal. I still think that's the key development of 2017 so far. And if you go to a daily chart, this is where we got that powerful explosion on Tuesday the 17th, and we're still going to the upside. I mean, ultimately, just shy of 128 is the level on the futures where we topped out in December. To get up to 128, I think we're going to need to see the idea that Theresa May's not going to get her wish on triggering Article 50 by the end of March. Any delay in the triggering of Article 50 is probably sterling positive. That might see us get up to 128 in the next few weeks, stroke next couple of months perhaps. Let's say it's a short bill and it looks like it's going to get voted through and it looks like Theresa's going to get her end of March wish, well then that's probably sterling negative. And no chance of getting to 128, and we kind of move back down below the 124 handle. Okay, so it's all about this bill. Is it short? Is it long? And timing on triggering the article. All right, so that's the Brexit update. You've still got equities up on their highs here, not adding much in the last 10 minutes or so. Let's just talk about bonds, because with this risk appetite, what we're getting is bond market movement to the downside. You're getting a decent inverse correlation here between risk and safe assets. And so I just want to go to a 60-minute chart first for T-notes, just to show you yesterday we came off the high point at the 125 handle that we had on Monday evening. Then we traded down, broke lower, and as equities powered to the upside, T-notes traded down to test Monday's low, which we've tested again this morning. Okay, just keep your eye on this, only because of what happened at the end of last year. If I go to a daily chart, ever since the election, which we've got in a box here on the top left, we've seen a big radical move lower in price and higher in yields. Now this year we bounced and then we've just consolidated and we're trading sideways. Okay, so this upward trajectory in yields that we had at the end of last year hasn't extended yet. Now I would, if this risk appetite we're seeing in equities leads T-notes down to test the low of the year at 123.25, any break of that, and I think this yield story is going to get back onto people's agenda, and ultimately rising yields, especially on the longer end where liquidity is worse, might start to trigger a low liquidity, much faster sort of sell-off here. People are worried about bonds in the long term. I show you the long term. If we go to like a quarterly chart, we had such a big rally in the last 30 years, and these price levels, the 2014 low is at 122.22, and that's where we tested after the election end of last year. Any break of 122.22 on T-notes in the coming weeks is very significant technically, and you could start to see quite a sharp move down below the 120 handle. And this will lead to rising yields, which ultimately is bad news for credit availability, tightening monetary conditions, and could start to lead to a negative force on equities. Okay, one thing that's helping with this, of course, is the energy and commodity space. Any upside on oil prices, as we got yesterday afternoon, all right, it's been given back now, is inflationary, and so leads to bond yields rising. So really, with bond yields, it's about Trump. Is he going to deliver his fiscal stimulus? His actions so far this week indicate that we might get this fiscal package sooner rather than later. And then it's about the price of energy, and it's the price of commodities. With oil, now that I'm on that topic, we got oil inventory data today. The reason for the sell-off into the close yesterday and why we're under a bit of pressure this morning is because the API numbers last night showed a build in supply. So it's the third weekly build in crude. So look at that. We've got these numbers on the right here showing increases in crude storage capacity. So this is more supply, negative for price. So we've also had a fourth large gasoline build in a row. So that's this circle that we've got down here. So crude supply has increased, gasoline supply has increased. This is negative for price. We'll see what the Department of Energy has got to say on this later this afternoon. I'll show you the data and what's scheduled in a second. All right, so let's look at the data calendar now, actually, because as I speak, in fact,
year-on-year 0.1.
German IFO is being announced.
Business climate 109.8, 109.8, below expected 111.3. Sorting out for expectations and the assessment.
So we're just getting German IFO data here. I've just turned up the squawk. So let's get the DAX into picture. Sorry guys, I missed that by about 10 seconds.
Current assessment 116.9, that's in line with expectations. The current assessment, still looking out for expectations.
So we'll still waiting for the expectations component. But the German IFO number itself is worse than expected at 109.8. We're expecting 113.3.
103.2, so that's 103.2, below expected 105.8.
Okay, so what's happened is the expectations component of IFO is worse than expected. That's the forward-looking element of the data set. The current conditions was in line at 116.9. It's the expectations component that's more important. Slightly worse than expected. Nothing major in this, really. Still, well, let me show you on the chart, actually. Let me switch up. Look at the chart here. So we've just had 109.8 announced, which means it's the worst reading for 3 months. All right, but up here, anything up around 110, if I show you on a 10-year chart, anything up around 110 is the best we've seen in the last 5-6 years. All right, so it's not like this is a disaster by any means, but it is slightly worse than expected. You had a marginal brief pullback on the DAX there. If I go to a 5-minute, hardly anything. I mean, we were very bullish. Anyway, just thinking about the Euro's value here, let me just have a look on a 5-minute chart. Euro's virtually unchanged, remains just up around the highs. And if we just check in on the Bund, the German government bond here, then very little movement there as well, actually. So you're not getting much action off this. A slight blip lower in the DAX, but ultimately slightly worse than expected on the more important expectations component, but it's still up around 110, which you can see on my chart is basically as good as it's been for the last 5-6 years. So I don't think this is really going to halt, or it's certainly not going to reverse risk appetite, which is positive. It might just cap the upside for now. I'm just looking at the Euro, which is actually just trying to edge to a further high, the high that we had overnight. This is just edging above that high we had at about 8:30. The high we had overnight, 107.57 on the futures. Sorry, it's actually just above that, isn't it? 107.58 on the futures is the high of the day that was set at 2:15 last night. Okay, just back to the data calendar, because that was the key bit of news flow for the morning. We've got some Italian and Swiss and UK stuff, but this isn't of any importance. And indeed, you would say, just looking down at the US stuff as well, really this German IFO number, on paper at least, is the most important data of the day, other than the Department of Energy oil numbers that we're going to get at 3:30. We do have the more earnings, and we've got US corporate earnings coming from the likes of Boeing and eBay. They're the two big ones reporting today. Also, we got some comments from ECB's Weidmann to look out for at 1:15. We did get an interestingly hawkish comment from the ECB yesterday, actually. I'm going to try and find the quote very quickly, but I seem to have lost it. Yeah. So Lautenschlager, who's definitely got the best name of all the ECB members, he said yesterday, all preconditions for a stable rise in inflation exist. I am thus optimistic that we can soon turn to the question of an exit. So it's Sabine. Ant's just embarrassingly reminding me that Lautenschlager is a female. So Sabine has said that she's turning hawkish. Now, the reason why I've mentioned that is because Weidmann, who's due to speak at 1:15, is also uber hawkish. And it'll be interesting to see if we get a second very hawkish comment in as many days, with regards to ECB members starting to talk about exits. I think perhaps it's a little bit premature, but they're looking at these PMI numbers, and they're looking at inflationary pressures just picking up, and the most hawkish ones on the committee are starting to actually pipe up. So this needs to be on your radar now. So that's coming, and that's perhaps not that the euro really had much of a move off that yesterday. If I just go back and finish by looking at a couple of charts, it's not like the euro in the end had a good session. It didn't. We finished down on the lows last night. So you're not really getting much action on the euro off the back of this. But it might help to push up Bund yields if we finish on the Bund chart. And if I go to the daily chart, what's certainly happened with Bunds more so than T-notes is we've made a new low for the year this morning. Bond yields, so prices dropped, yields rising. And if you get more hawkishness from the likes of Weidmann later, then this is only going to help with this. So 162.20 on the Bund is really key. And this really opens the door for a pretty clear move down to the post-Trump election win lows that we had back in November. So just keep your eye on these bonds as they start to gather some momentum. It could become a story in the days and weeks to come. All right, that's it for now then. Let's see how this German IFO data pans out. I mean, at the moment it's halted the upside on the DAX, but you're not really getting much action off this because in the end of the day, it's, even though slightly worse than expected, it's still a nice, solid, strong reading. All right, that's it, guys. Enjoy the session. Thanks.